Hello everyone, welcome to Business School 101. Have you ever wondered how startup companies get their first big break? How do new businesses without revenue or credit history raise money to build their ideas? The answer often involves angel investors, wealthy individuals who take risks on early-stage businesses in exchange for a slice of future success. In this video, we're going to explore what angel investors are, how they work, what they look for in startups, and why they can be a game changer for entrepreneurs. Whether you're starting your own business or just curious about how startups are funded, this one's for you. Section 1. What is an angel investor? An angel investor is a high-net-worth individual who provides capital to startups or early-stage companies, typically in exchange for equity or partial ownership in the business. They're called angels because they often invest when no one else will. Banks won't lend. Venture capitalists think it's too early. But angel investors believe in potential and are willing to take a risk. These investors usually write smaller checks than venture capital firms, but they get involved much earlier in the life of the business, sometimes even before the company has a product or revenue. Section 2. Who are angel investors? Angel investors are typically former entrepreneurs who've built and sold companies. Wealthy individuals looking to diversify their investments. Industry experts or executives who want to support innovation. Or even friends and family of the startup founder. They often invest their own money, unlike venture capitalists who manage other people's funds. And while they care about returns, many angels are also motivated by passion, mentorship, or helping the next generation of founders succeed. Some angel investors operate individually, while others join angel networks or syndicates to pool resources and share risks. Section 3. How do angel investments work? Let's walk through how a typical angel investment works in practice, step by step. Step 1. The pitch. It all begins when a startup founder presents their business idea to a potential angel investor. This could take place at a formal pitch event, a one-on-one meeting, or even through a personal referral. During the pitch, the founder outlines their vision, the problem they aim to solve, the proposed solution, the business model, target market, competition, and growth strategy. The goal is to convince the angel that the startup has both potential and a capable team to execute the plan. Step 2. Evaluation by the angel. After the pitch, the angel investor moves into the due diligence and evaluation phase. Here, they carefully assess several key aspects: the business model, how the company will make money, the market potential, size of the opportunity and demand, the competitive advantage, what makes the business unique, the founding team, their background, experience, and chemistry, and any early traction, such as user growth, pilot customers, or partnerships. This analysis helps the angel judge whether the investment is worth the risk. Step 3. Investment terms and structure. If the angel likes what they see, they may decide to invest in the startup, usually in amounts ranging from $25,000 to $250,000. The investment can be structured in one of two common ways: as equity, where the angel gets a percentage of ownership in the company, or as convertible debt, a loan that can be converted into equity at a later funding round, often at a discount. The terms of the deal are negotiated and formalized in a legal agreement. Step 4. Mentorship and added value. Angel investors often contribute more than just money. Many provide ongoing mentorship, strategic advice, and industry connections that help the startup navigate early-stage challenges. This could include help with hiring, product development, marketing strategy, or preparing for the next funding round. An experienced angel can play a crucial role in a startup's growth by acting as both investor and trusted advisor. Step 5. Risk and return. Angel investing is considered high risk, high reward. If the startup becomes successful, whether through a profitable acquisition or an initial public offering, IPO, the angel may receive a return many times their original investment. However, if the startup fails, which is not uncommon, the angel may lose their entire investment. That's why this type of investing is only suitable for individuals who can afford to take financial risks. Step 6. Portfolio strategy. Because of the inherent risk, smart angel investors don't just bet on one company, they build a portfolio of startups. By investing in 10 or more companies, they increase their chances that at least one or two will succeed and generate a strong enough return to offset any losses. This diversification strategy is a key principle in early-stage investing and helps manage the volatility of startup outcomes. Section 4. What do angel investors look for? Angel investors don't just throw money at every idea, they're selective. Here's what they usually want to see. Number 1. A strong founding team. For most angel investors, the people behind the business are just as important, if not more, than the idea itself. Investors want to know, are the founders driven, passionate, and resilient? Do they have relevant industry experience or a track record of building and scaling businesses? Are they coachable and open to feedback? Since early-stage businesses face constant challenges and uncertainty, a strong, adaptable team with the ability to execute is often seen as the startup's greatest asset. Number 2. A big and growing market. Even a great product won't go far in a tiny market. Angel investors typically look for startups that target a large, addressable market with room to grow. They ask, is there widespread demand for this solution? Can the company scale nationally or globally? If the market opportunity is significant, the chances of achieving a profitable exit, like being acquired or going public, are much higher. A bigger market means bigger potential returns. Number 3. A unique product or service. Investors also seek a unique value proposition, something that differentiates the startup from existing competitors. What makes this product better, faster, cheaper, or more innovative? Is it hard to replicate? Does it solve a real, urgent problem in a new way? Startups that can clearly communicate their competitive edge are more likely to attract investment, especially if they can defend it with technology, intellectual property, or customer loyalty. Number 4. Early traction and validation. While angels may invest before a company is profitable, they usually want to see some evidence that the idea is working. This could include a working prototype, initial sales, pilot programs, customer testimonials, or partnerships. These signals, called early traction, help reduce uncertainty and show that the startup is moving in the right direction. It proves that people want the product and are willing to pay for it. Number 5. A clear exit strategy. Finally, angel investors want to know how they will eventually get their money back, and hopefully make a profit. That means the startup should have a clear exit plan, such as being acquired by a larger company, merging with another firm, or going public through an IPO. Since most angels invest in exchange for equity, they don't earn returns until that exit happens. A well-thought-out exit strategy reassures investors that the founders are thinking long-term and understand the investment lifecycle. Section 5. Real-world examples. Let's look at 2 examples that show just how powerful angel investing can be. Number 1. Amazon, Jeff Bezos's early boost. When Jeff Bezos left his Wall Street job to launch an online bookstore in the 1990s, he needed seed funding to get started. He turned to friends, family, and individual investors, raising around $1 million from a group of about 20 angels. One of those early backers invested $50,000, which later grew to be worth hundreds of millions as Amazon became a global giant. Without those early angel contributions, Amazon might never have made it past the garage stage. Number 2. Google, a game-changing $100,000 check. In 1998, before Google was even incorporated, co-founders Larry Page and Sergey Brin pitched their search engine idea to Andy Bechtolsheim, co-founder of Sun Microsystems. After just a quick demo, Bechtolsheim was so impressed that he wrote them a $100,000 check on the spot. This angel investment helped them officially launch the company. That single check became one of the most legendary angel investments in Silicon Valley history, earning Bechtolsheim a return in the billions. Section 6. The risk behind the reward. While these stories are inspiring, they also come with a reality check. For every success like Google or Amazon, there are hundreds of startups that never scale, run out of money, or shut down completely. Angel investing is not a guaranteed win, it's a high-risk game where only a few investments may deliver a return. That's why experienced angels diversify their investments and accept that most may fail, while hoping 1 or 2 become the next big thing. Section 7. Conclusion. In summary, angel investors are early-stage backers who provide funding, mentorship, and belief to startup founders when few others will. They take on high risk in hopes of high reward, and their role is vital in turning ideas into businesses. If you're starting a company, angel investors might be the bridge between your idea and your first big milestone. And if you're an investor, becoming an angel can be both exciting and impactful, just make sure to do your homework. That wraps up today's lesson on angel investors. If you found this video helpful, don't forget to like, subscribe, and leave your questions in the comments. Thanks for watching, and I'll see you next time.